The credit market should remain buoyant. Current fundamentals support the credit asset class that will be a preferred asset choice for 2026, thanks to moderate growth in Europe, inflation close to the European Central Bank target, stable credit quality, leverage under control, and contained default rates. Credit bonds do benefit from attractive yields, although spreads appear slightly tight compared to a 10-year history. Investment-grade credit is still a decent investment proposal within asset allocation. That said, to capture a larger carry, we do favor crossover and, on a selective basis, high yield. There's two alternatives combine attractive yield plus low duration, which is key in our scenario of a further rate curve steepening. In addition, we maintain a preference for bank debt that should deliver a higher relative performance than non-financial issuers. In 2026, the default rate is expected to be maintained at 2% by the European Central Bank throughout the year. Thus, the money market may appear increasingly less and less appealing. That's why investors will have to take a bit more risks to achieve 3, 4, or even 5% total returns by targeting higher carry asset classes such as high yield or crossover. As for risk, we know how to manage them on a day-to-day basis, but the increasing geopolitical risk, series and events, is the most complex to factor in, although for the moment its impact on market is quite limited. In a rise, two additional factors may fuel further worries and volatility. First, the massive investment needs for large-scale data centers, which are called hyperscalers in artificial intelligence. Second, the size and the opacity of the private credit market, particularly in the United States.